Hello, so today we're going to talk about risk. Risk seems to be a big word that if asked to define, nobody really has a concrete answer for it. And when we're talking about investments, there is so much risk out there, but we really need to understand what it all means. So today we're going to look at 7 different types of risk that as an investor you should be familiar with. So the first type of risk we're going to look at is market risk. So market risk is the risk of something happening broadly across the markets with very little discrimination. So think of it as during COVID, the first thing that happened when it was a pandemic is everything in the markets collapsed, no matter what it was. Everything went down. And vice versa is true that in good markets, everything rises. That is called market risk. And that is something that we can't diversify away from. It's something that is always present when we're investing in the markets as a whole. The second type of risk we need to be aware of is interest rate risk. So interest rates affect us in multiple different ways, from the interest rate we pay on our mortgage to car loans to the interest we receive when we hold bonds. But further than that, they also impact companies. So it's very typical for a company to hold debt, and that means that they have to pay down debt. That means that's also affected by interest rates. If a company has $1 billion worth of debt, paying an interest rate of 1% versus 2% on that rate on $1 billion is a lot of money. So it impacts us even further than we may realize. So the third type of risk that we need to be aware of is individual business risk. Think of it this way. If you wanted to hold all of the wireless carriers in Canada, you're hoping that the industry as a whole does well because a rising tide lifts all ships. But if you just hold one of them companies, well then the focus isn't on the industry, it's on that one company doing well within that industry. And it works both ways. If you hold the company and it does really well, well then your investment goes up a lot. If it doesn't do so well, it doesn't matter how the industry is doing because that one company is doing poorly. And that's called business risk. And that's why we diversify our investments to get rid of as much business risk as we can. The fourth one we need to be aware of is inflation or purchasing power risk. So this has become more and more important today as interest rates have gotten lower. No longer do GICs keep up with inflation. So if we think inflation's around that 2% mark, if you're not at least earning that on your money, well then you're actually losing money, which is why annual raises and things like that are an important topic of conversation, because if one year you earn $70,000 and the next year you earn $70,000 and in 10 years time you're earning $70,000, well what you can buy with that $70,000 has just reduced throughout that time. So $70,000 might meet all your needs today, but in 10 years that same $70,000 won't. The fifth risk we're going to look at is volatility. And this is an important one because when you're talking to any advisor and you're looking over the funds and stuff like that and it has a little risk rating, like low to medium, high and all that stuff, that's volatility risk. That's not any other risk but volatility. And what that means is how much in a normal given period will that investment move. That's all it's referring to. So think of it this way. If the investment would normally move between -1 and +1%, well, it would be considered low volatility because it moves not much. But if that investment would normally move from -5 to +20%, well, that's now very high volatility. And to drill home this point even further, if this investment went from 0 to -1 every single year, that is a very, very low risk investment because it's got low volatility. So it's important to understand that volatility risk is not the same as our number 6, absolute risk. Absolute risk is the risk of you losing your money outright. And there are a lot of types of investments where that is a significant risk. But what we've seen in history with a well-diversified portfolio, we can get rid of that risk almost entirely. And then number 7 is the risk of you not having enough money. And this is probably the risk that concerns the people the most when they think of investments. They either think of a crash happening and them not having enough money and them needing it, or they look at retirement and they say to themselves, hey, I don't have enough money to live. What if I make it past 80? What if I make it past 85? What do I live off? And that is the risk that planning is solely based around, making sure that we have enough assets and enough money available to meet our needs. So they're the 7 risks that really we need to understand as investors. And there is way more risk, different types of risks out there. But it's important to know that there's ways to deal with all these individual types of risk. So think of it this way. When you first got in a car, behind the wheel, how did you feel? Well, I know for me, I was sat behind the car and I was thinking, it was a tiny little car, but I was thinking this car is massive and I'm here trying to control this big vehicle. And then you get a little bit more confident, and then if you're anything like me, you go through the dumb stage where you're in parking lots and you're drag racing your friends. Don't recommend it. But you become a little bit reckless and you think you're invincible almost. And then you get past that stage and you get into the realistic stage. And the fact is when you're driving a vehicle, you have other people's lives in your hand. If you have kids in the vehicle, if you have family in the vehicle, it's not only you. You're responsible for all these lives. You're also responsible for the lives of the other people on the road. But you can learn to manage these risks. And so you drive safely, you follow the road, you follow the laws, you do things, you put things into place, you wear seatbelts, you put things into place to manage these risks. And it's exactly the same when it comes to investing. There are lots of risks out there, but there's a lot of upside. With driving, you get to do things that you would never be able to do. Even a small trip to the shops, that's a 10-minute drive away. Imagine if you have to walk that, that's crazy. But you get to do that and get that opportunity because you learn to manage the risks of driving and operating a motor vehicle. And it's exactly the same in investing. The markets are a phenomenal force that can allow people to build wealth like never before. It can open doors, it can have opportunities, but only if you learn to manage the risks effectively. There have been tons of people that have crashed and burned in the markets because they didn't follow the risks and address them correctly. And there's been many people that have went their whole lives and had a great experience and have been able to do what they've always wanted to do and what they've dreamed of and thought they never would be able to do because they've managed the risks effectively when it comes to the markets. So a key concept is understanding risks and knowing how to negate these risks and what risks we don't want to negate. But hopefully that gives you a good idea of what risk is and how we go about dealing with that risk. As always, thanks for watching, and if you have any feedback, let me know. If you have any questions, let me know. Feel free to reach out to me. I guarantee if you have a question, somebody else has a question, and maybe I can address it in a later video. These videos are designed to educate, to help people make better decisions when it comes to their investing knowledge and their personal lives. So feel free to share this video as well. If you have family or friends that may be worried about investing or don't know as much as you may think they should do, these are a great source to help them type of people as well.